Hey everyone, and welcome back to Everything Tesla Stock. Tesla stock has received several predictions from different stock analysts and Tesla bulls over the years, and now there is one more on the list. But this time, it's something huge, an uncommon revelation that Tesla stock might actually be worth way more than the current price, a whopping $3,369 per share. This was revealed in a report by a multi-million-dollar investment firm using a 30-year discounted cash flow model for Tesla. Why did they give this crazy evaluation though? Well, we've seen Tesla skyrocket before and do the unbelievable, but could it do it again? When? Well, let's see how this all stacks up. It's pretty crazy. Although Tesla stock has not been doing too well recently, it's still on a positive trajectory. And who knows, the $3,369 stock price might deserve some attention. Let's find out. Before we start, if you like this type of content, hit the like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. Holon is a global equities management firm with a long-standing reputation in innovation and investment. The Sydney-based firm believes Tesla shares are worth 5 times their current value, being at $673 at the time of this recording. This is following 12 months of research that resulted in a 144-page report on Tesla. Revealed by Holon's managing director and portfolio manager Heath Benck and its research director Tim Davies, the report estimated the stock price of $3,369 per share. But why was that? Holon's report stated that Tesla's production is going to skyrocket to about 51 million by 2030, 136 million by 2040, and 184 million by 2050. Obviously, these values are nowhere near the minimum, and it's going to take a lot to achieve that, but the two of them believe that there is a way around it. According to a report, this estimated stock price is based on a prediction of future rise in the demand of electric vehicles, which can be forecast by 2 major factors. The first being the possible future ban by the government on internal combustion engine vehicles, in a bid to reduce carbon emissions from transport. And the other is an increased rate of development in countries like China and India, which could possibly raise income levels and consequently the rate of car ownership. Moving to figures, Holon estimated that this ban could raise the number of electric vehicles in circulation to about 1.97 billion by 2040. This is 24% ahead of the $1.6 billion value forecast by the International Energy Agency. Likewise, car ownership in India and China is likely to surge to 40 and 30% respectively in 2050, which could bring small electric vehicles like Tesla's future Model 2 into the limelight. This could be a big deal for Tesla. Going by these estimates, could it be said that investors might not be focused on what really matters at Tesla? Well, possibly. Tesla is a growth stock, and the yardstick for its valuation is what lies ahead for the stock, rather than what it makes in 2022. Based on Holon's predictions, there could be a possible future surge in car demand which will greatly boost Tesla's production rate, and thus will affect the stock value. And for what is expected, the price could be high in the positives, raking in enough income for Tesla's investors. So maybe investors might need to rethink a bit before selling off their Tesla stocks. Also, Tesla is well placed to dominate the EV market in the years to come, and the car company has a lot of long-term growth prospects. Although there could be debate around Tesla meeting its production aims this year and in years to come, the predicted years inclusive, Tesla inarguably has the potential to perform beyond expectations. No doubt this will be an arduous task for the car company, and its stock price may waver, but issues like this shouldn't unduly trouble a long-term investor. Speaking in long term, there seems to be a lot in the works for Tesla, and Elon Musk has revealed many of Tesla's future plans which could potentially take over the EV market. Optimus, the humanoid robot, which Elon Musk claims will be worth more than the car business, Tesla's robo-taxi, for which a ride will cost less than a bus ticket, and major efforts towards fully self-driving cars. Now the argument would be, are these projects actually achievable? The fact that the market is lucrative for Tesla's exciting growth programs means that the projects are more than likely to happen. Tesla will most likely invest in a project whose market awards the company a high valuation and can help it raise capital cheaply. According to Holon's report, the use of artificial intelligence and robots across Tesla's entire manufacturing process helps it to deliver industry-leading profit margins that are substantially higher than its internal combustion engine vehicle competitors. Likewise, Tesla controls its own sales channels, which provides the company with substantially higher margins than traditional automakers that rely on dealer-distributed networks. There is, however, no doubt that Tesla can boost its sales if proper measures are employed. Assuming Tesla uses a modular manufacturing model to add production capability and capacity to its existing factories and future ones, it could massively increase production while cutting down operating costs. However, the challenge here, which is also the biggest threat to Holland's forecasts, is that there might not be sufficient raw material supply to meet lithium-ion battery demand. For Tesla to meet the production forecast until 2030, lithium supply will need to grow by 298%. Also, Tesla will have to do a lot to make enough electric vehicles to capture gross demand. The automobile industry is currently facing production issues following the Russian-Ukraine crisis, and Tesla is not immune to these challenges. This has left investors somewhat concerned, since failure to meet these targets could affect the stock valuation and the stock price. Tesla's closure of its San Mateo, California office and elimination of jobs with autopilot workers further heightened their concerns, as several analysts cut their estimates of the stock. However, going by Tesla's growing reputation, this should not be something to worry about. If Tesla successfully overcomes its setbacks on raw materials, it can easily convert the future increase in demand for electric vehicles into a massive financial boost. Holland predicts Tesla's annual free cash flow to reach about $500 billion by 2037 and $1 trillion by 2047, which will allow dividend payments and share buybacks to start from 2025. If all goes as expected, Tesla could accumulate long-term investment assets reaching $20 trillion by 2050. It further stated that Tesla's revenue from EV software and energy production could hit $2 trillion before going to $3 trillion in 2039 and 2047 respectively. So much is on the way for Tesla. However, we could be getting too excited about Tesla's more speculative growth prospects, and that's not too ideal. But similarly, it could be a mistake to expect too less from Tesla. The current limitations do not decide its valuation over the long term, and there's a big chance that Tesla could actually be worth the $3,369 price value. Tesla is positioned to dominate the EV market, and with the plans set for both the short and long-term period, Tesla could be graduating to a force too big to compete with. Holland predicts that there will be a new gigafactory launching in Southern Europe, India, and China over the next 5 years. This may be worth the hype, since Tesla's 2 new gigafactories in Nevada and Berlin are set to start production soon, and with increased production capacity, Tesla could accelerate its annual car production to 5.5 million in 2025. There are many reasons why Tesla can meet many of Holland's estimates. The EV company has a reputation in autonomous driving software, and that gives it an edge over most of its competitors. Its FSD Level 4 autonomous system is also expected to arrive in 2025, and this will be another positive milestone for Tesla. Taking it a step further, Tesla's newly integrated energy solutions that combine solar panels, battery storage, and electric vehicles into a single product offer long-term savings options for Tesla users. This is something most of Tesla's competitors like GM and Ford are currently drowning in a $250 billion debt, and they will struggle to keep up with it. The EV company utilizes its advantage to capture massive volume of data, which is needed to develop and test an effective autonomous system, and that's led to several remarkable productions from Tesla. Holland believes Tesla will continue to dominate the EV market for years to come. And Benck and Holland's managing director pointed out that this trend in car purchases is likely to change in coming years. And if positive, Tesla could experience a massive surge in its price. That said, investors may be focusing on the current state of the stock rather than the underlying fundamentals of the business, which most times is the major detriment of a stock. It should go without saying that Tesla is no cheap stock, currently trading on 44 times Wall Street analysis estimates for free cash flow in 2024. Therefore, going by Holland's previous estimates, there could be more about Tesla stocks than most people see. Based on previous performance, Tesla is likely to maintain its dominant market position in the EV industry and continue to expand its profit margin through increased production in the coming years. But of course, there is nothing guaranteed, and like any stock, there's still a debate around Tesla's valuation. So you should buy the stock only if you see value in it. But what do you think about these estimates? Can Tesla stock actually be worth $3,369 per share? Let us know down below, and while you're still here, go ahead and click on one of these 2 videos on your screen. See you there.